Imagine waking up every morning, opening your crypto wallet and seeing new coins appear. Not from trading, not from guessing the market, but from running the infrastructure that powers crypto itself. Most people believe money in crypto is made through trading, memecoins, or getting lucky with the next big ICO. But there is another side of the industry that many investors overlook. Blockchain nodes. Nodes are the computers that keep a blockchain running. They verify transactions, store the network's data, and help produce new blocks. Without nodes, blockchains like Bitcoin, Ethereum, or Solana simply wouldn't exist. Because nodes perform this critical role, networks reward them with newly issued tokens and transaction fees. In other words, node operators get paid for helping secure the network. This creates a very different dynamic compared to trading. Traders try to buy low and sell high, but they depend entirely on market timing. If the market moves against them, they lose money. In fact, studies show that the majority of traders eventually lose their capital because markets are volatile and emotionally driven. Node operators, on the other hand, accumulate tokens over time regardless of short-term price movements. One of the most powerful examples of this comes from the Solana network. When Solana launched, early validators needed to run nodes to support the blockchain. Setting up a validator required technical knowledge, reliable servers, and a financial commitment that in many cases was around $25,000. At the time, Solana was almost unknown and the token price was only a few cents. But node operators were earning SOL, tokens every day as rewards for validating transactions and producing blocks. As the network grew, those rewards kept accumulating. Then Solana experienced explosive growth, with the price eventually reaching over $200 at its peak. Early node operators, who had been collecting tokens for years, suddenly held massive positions. Some validators accumulated tens of thousands of SOL, turning an infrastructure investment of around $25,000 into holdings worth well over $14 million. This highlights the difference between speculation and infrastructure. ICO investors buy tokens hoping a project succeeds. Traders try to predict short-term price movements. Node operators participate directly in the network and earn tokens as the system grows. Of course, running nodes also has challenges. It requires technical setup, reliable hardware, and choosing projects with real potential. But for those who understand the infrastructure layer of crypto, nodes represent one of the most consistent ways to accumulate assets in the ecosystem. Instead of chasing the next hype coin, you become part of the technology that powers the entire network. So the real question is this: will you only trade crypto, or will you help run the networks that make crypto possible?